just a negative start across the Asia Pacific, considering the session that we had on Wall Street.
India is the best long-term equity market in the world.
The SEBI has put out a consultation paper which talks about introduction of a new asset class.
Perhaps it's not just China, it's also Taiwan in its crosshairs.
It has that valuation comfort in comparison to its global peers.
LTI Mindtree beat street expectation, a modest beat, but there is a beat on the top line.
But there's been a large swathe of brokerage cuts on Asian paint.
Up 70 points lower on the Nifty, 180 points down on the sensex.
Been observing through the month of July so far is the larger cap names are starting to make a comeback.
Demand trends in domestic are looking, nice.
Bunch of problems with Z funds coming in, but they are coming in with some riders.
In my view, the budget will revolve around 6 pillars, and one of those pillars will be job creation.
In the airport sector, we are at a very sweet spot.
The Nifty and the Sensex have dipped in the red, though they were holding up in the green for a greater part.
A very tough quarter where the retail was affected in April and May. We have kind of seen good demand coming back in June.
National economic and financial risks to valuations have diminished.
Sharpest strategies, top market trends, unmatched perspectives. The trading day's most comprehensive roundup. Stay ahead with NSE Closing Bell. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Well, we are up. What else? 200 points on the Nifty. It's an incredible day with a sharp reversal led by IT stocks from the day's lowest level. Lots to discuss here, lots to take forward. It's been busy and it will be busy over the next couple of days as well. Infosys numbers, we will discuss what to expect because that is essentially the stock which I think is raising expectations for the whole sector. I'm Prashant. With me, my colleagues Surabhi and Rima here in the studios, and Nigel is joining us from the newsroom floor. Guys, hi, good afternoon.
Hi, afternoon. It's an IT, ICICI Bank and Reliance-led rally because the broader market is just not participating. The mid-cap index is down 1% with the advanced decline ratio at 1:2.
Yeah, and we've got some, recent numbers coming in, mid-cap numbers. Not the best, not exactly in sync. Havels, you can see the reaction on your screen. Polycap came slightly shy of expectations. We'll discuss all this and more. But yeah, Nigel, a bit of a wobble, I guess, in the mid-caps today.
Well, that's right. And what about HUL? You know, that big heavyweight, after not moving for a long time, it's given you a quick fire 20%, I think, in the last 45 days or so. So that's another big mover. But as you all said, it's a large cap day with the mid caps showing a relative underperformance. And as we highlighted earlier today as well, between today as well as tomorrow, either companies that will be reacting to numbers or could be reacting over the weekend, 35% of the Nifty will be reacting to its numbers in the next 48 hours or so. So interesting times.
Absolutely interesting times. You know, at a slightly philosophical level, I mean, you know, you come back and you see US markets are down and things are painful. You know, for a moment, you forget the market you're in. And you say, well, okay, this is negative, earnings are bad, markets will be down.
Yeah.
And markets were down. But then...
Till about 11:30. I mean, there was a big slide that was underway.
Yeah, I mean, there are lots of caveats. For example, I mean, in the morning, we were pointing out how Dow was up today. Nasdaq was down, S&P was down, Dow was up, and I was wondering what to make of it. But as someone said, if you looked beneath the constituents, Dow Oil, Dow Industrials, and a lot of other sectors, so it was a semiconductor-led cut that we had in the US overnight. So there is that as well. I mean, and I think there is acknowledgement of that. But I think even without that, I mean, you know, it's a market which people have been waiting to buy the dip, and the dips have not been coming. And when they come, people get in. So just to sort of run you through a few points, the low today is 24,504. And the 40-day, this is the level we put out in the morning in terms of supports. The 40 days, as of yesterday's close, was day before yesterday's close was 24,480. So you almost touched the 40-day, not quite, 20 points away, and then, bounced from the lows. IT stocks powering a big rally. Infi later today. Can it do something dramatically different as compared to what we've seen from IT services so far? Gains also in FMCG and private banks as pockets, losses in PSUs, real estate and metals. PSU banks are okay. I mean, the index is up 1/3% or something, but CPSE generally is a pack, and real estate and metals are also seeing some losses. Broader market breadth is negative in mid-caps and small-cap indices. The last I looked were down about 0.75% to about 1% or so. So that's essentially the picture we have.
Well, Infosys numbers, the press conference is about 4:30, so numbers should be out before that. But, you know, after 3 beats, TCS, HCL Tech and LTI Mindtree, and all 3 large cap IT names, if Infosys comes out and reports decent numbers and talks about some green shoots in recovery, I think the confidence in IT only goes up that much. And IT has been the big star. In fact, I was checking, the recent low was close to about 1400 if you pull up a 3-month chart, and the stock has moved up to 1750. So that's a good 20% up move in a span of 45 trading days. 1400, sub 1400 was the recent low on Infosys. But outside of that, ICICI Bank and Reliance Industries are the other 2 big contributors. Pull up the contribution plate and you would see about 20-25 points is coming in courtesy TCS, Reliance and an ICICI Bank. And ONGC has been the big mover this week. Every single day it's been moving up nearly 2%, 7% rally in the last 3 trading sessions. HUL has been smart, and SBI life insurance companies have come back this month with gains of about 10-12% for many of them.
Absolutely. That's, how it's playing out. I was looking at numbers for Central Bank of India. Good numbers. I mean, margins have also held steady. We'll talk about a lot of these earnings reviews as we go along. It's just because, a lot of PSU banks are doing very well. So I was looking at these numbers in particular. Net interest margin at 3.57 versus 3.58 quarter on quarter. Asset quality has been stable. So no problem there. Stock is very, very range bound. Otherwise, PSUs are not doing too bad. You've got the likes of UCO, SBI, IOB, a lot of those stocks on the upside of the screen. But there has been some profit taking on the railway pack and the industrial, PSU industrial. So RVNL, for instance, still down about 5%. You've got BHEL, BEL, Aerocon. A lot of these stocks are still in the red. That's the afternoon for today. Nigel.
Well, that's right. Since today is the weekly expiry as well, the 24,785 is a very, very crucial mark on the upside. We were explaining the short straddle earlier today, and that was the marker. Intraday, we have gone around 40 points higher from those levels, but we have come back down. So we are hovering in this vicinity of around 24,800. We'll want to get past that. If that is the case, if we can hold above the 24,800 odd, we can see a bigger spurt in trade towards the end purely because of the expiry related factor. But otherwise, positioning was such at the start of today that the 24,800 mark will hold out. So let's see how that goes. And 2 stocks that we highlighted, one was Manappuram Finance. That could be a relative outperformer. It has valuation comfort, as well as gold prices at multi-year high. So that's moved well today. It's at the high point of the day. And Indus Towers as well. That's been the rank outperformer. Even in Tuesday's trading session, it ended at the high point of the day today as well. It's holding steady even when the markets are quite volatile. We are seeing a consistent, consolidation or a bit of a positive bias on that stock as well. And just one more point, the cement names. Orient Cement, well, that stock has seen a big spurt in the last 1 hour or so. And India Cement has been moving higher all through the trading session. The street is bracing for this battle for these assets, and they believe the final word has not been said. And they believe that there's going to be a battle between the 2 large names. That's the Birlas as well as Adani. So that's why for the time being, you have a couple of these names that are moving up. And going by the screen, I think we'll be in for some kind of news flow on both these 2 companies. Well, let's find out how do you position yourself for the final hour of trade. Mitesh Thakkar joins us to help us out with exactly that. Hi, Mitesh. First, a quick word on the Nifty, and then you could fill us in with your stock picks.
Good afternoon. So I think another day, another fresh eye. The markets which were looking slightly tepid at the beginning of the session have picked up very nicely, and I think met the targets of 24,850 was nearly met. I would say 24,830 being the highs. I think for one target is met. But otherwise also I think there's no sign of weakness as yet. So maintain a long bias, positive side bias. I have in fact a couple of buy calls. Tata Consumer is something, which has been good. So that's a buy with a stop at about 1173. Look for targets of roughly around 1220 to about 1225 on the upside, and maybe even better levels can happen if the stock continues to show good momentum. And the other one is Torrent Pharma, which I would recommend buying with a stop at 3,000 for targets of 3120.
Any thoughts on Infosys in the chart?
Well, I've been liking the entire IT pack. The only thing is that Infosys in the last 8-10 days has run up a bit. The earlier weekly high was, around 1790, 1797 zone actually, which was way back in April of 22. So around those levels, around 1800, 1810, 1020, I think you will see some supply and profit booking emerge. But otherwise, the chart is as good as it shall be.
Okay. Thank you very much for that. All eyes will be on Infosys, and a quick run through what the street is expecting. A top-line growth of 2.5%. This will be partly on account of execution of the recently won deals, and secondly, because of a reversal of 100 basis points impact, a negative impact that it had in the prior quarter. In terms of margins, 20.7%, up 60 basis points, and that will drive a 3.5% increase in the company's profitability. Expect the company to hold on to its guidance, 1 to 3%, and margins of about 20 to 22%. But there is, if Q1 positively surprises, and there is a if over there, the only reason we're highlighting is because some of the other IT companies have come out with a positive growth surprise in Q1, whether it's TCS, HCL Tech. If Infy comes out with a positive guidance, then the chances of a guidance upgrade for the full year are very high, because a 1 to 3% guidance is fairly conservative. That's what analysts are saying, because in the prior year, the company had to lower its guidance 2 or 3 times. So this time, they just wanted to be very conservative and make sure that they're just baking in execution of the existing won deals. So if growth positively surprises, then perhaps you should look at a guidance upgrade too. But the street expectations are, that this time Infosys will report numbers which are on top of the Tier 1 leaders pack with a 2.5% top line growth. Devin, thoughts on Infosys between Infy and TCS, which one looks attractive? Because TCS continues to run after it reported its numbers.
Yes, Rima, good afternoon. Well, definitely, I think both Infosys and TCS, one thing remains common, that they have been cornering some of the larger deals, the big size deals, even though they are not, I think, they are not coming in, I think, big numbers as far as I think the activity is concerned. But I think as far as the volume is concerned, over the next 5 years or so, I think they are basically seeing the visibility of execution of these deals. In my viewpoint, I think the downside in the IT space probably seems to be limited, because on the other side, the customer is basically wanting to spend money for acquiring the newer technologies, their blocks, and also for the purpose of larger amount of game plan that they would have in their respective businesses. In each of the verticals, I think the TCS has demonstrated that they have got probably, I think, better amount of inquiries than what they were having before. Same situation would hold true for even Infosys. So yes, I think the commentary would matter as to how exactly I think they want to beat the entire street expectation moving forward. I think that would matter most. But yes, I think the markets have possibly started pricing in this possibility. Maybe Infosys kind of company currently quoting on trailing 12 months at around 26, 27 times price earning ratio. It may probably, I think, have further momentum if we see the larger deal announcements of that sort, I think, from the management.
Okay, that's Infosys, and we'll have more clarity once those numbers come out just in the next few hours. By the way, look at Just Dial. That really has to be the stock of the day from an earnings perspective. The stock is up almost 19% even as we speak. And throughout the day's volatility, mid-caps cooling off, this has been a rock-steady story, 19% higher. Just Dial's margins almost touching 29%. And Rima was telling us earlier that's the highest, I think, in what, 4 years?
2016.
2016. So
almost 8 years.
Almost 8 years. And that explains the market's enthusiasm around it. Devin, do you look at Just Dial? Have you seen the stock or the company of late?
Yes, I think though we don't have it under our active coverage, but yes, have looked at this particular company. They basically both advertisement-based revenue as well as subscription-based revenue. Both this particular revenue stream is basically getting the higher amount of traction at current levels, because largely the action plans with Reliance Retail, who holds this particular company. So from that perspective, the entire merchant space is contributing significantly high. But more importantly, I think what they have done is they have automated the entire process of either collection of money by the way of subscription on a monthly basis, or even for that matter, I think advertisement revenue that they are having. I think the entire process has been automated, digitized completely. And that has started contributing substantially since last 2 quarters, 3 quarters into the profit margin. And that is what is more encouraging, that this particular company, which was up till now, I think, dependent on too much of manual processes, is now working on efficient processes, so that I think the cost has come down, margins have started improving. Not too sure about the valuation at this point of time, because I think I don't see the sustainability part emerging as strong as I think the market price is. So from that point of view, I think would refrain from putting in recommendation. But otherwise, I think the numbers looks reasonably good at this particular point of time with the quarter results.
Okay, all right. Hi, Deven. Good afternoon and good to see you in. I want to ask you about the mid-cap cement space. You know, you have stocks like India Cement. We had a large trade that took place, I think, at around 270, 280 rupees when Ultratech went ahead and bought Mr. Damani's stakeout in India Cement. And now the street is bracing for there will be some other action. Either there is some competition or Ultratech goes the whole hog and tries to take a bigger chunk in the company. The stock is up close to 10%. It's difficult to justify the company at these valuations of around 350 rupees. But what's your view on India Cement? And maybe you could comment even on Orient Cement, because valuation-wise, that asset appears far better. You know, it has limestone reserves. It can expand. And also, on the valuations, it's not so expensive. Your take.
Absolutely, Nigel. Good afternoon. Well, I guess I think on valuations, I think those stocks are looking, I think, reasonably priced. I think not very expensive either. And given the kind of strength that the larger players have, like say, for example, you mentioned Ultratech or even for that matter, Adani Group, who have been on acquisition spree, I think largely the game plan seems to be that on one side, India's infrastructure story is continuing. So obviously, cement as a commodity is going to be in demand. On the other side, I think the way in which the cement is getting consumed, I think now versus I think likely to get consumed tomorrow with the prefabricated blocks, I would think that I think industrialization of this activity would probably give the players, I think, the premium pricing also. And at the same time, I think when you have the logistic management set well, particularly in case of Adani Group, where they have got east and west port connectivity systematically, so that brings down the transportation cost. I guess I think limestone reserves, bringing down the cost of transportation through logistic management, and also conserving or reducing the cost of energy through use of renewables. I think that is something which is likely to grow the portfolio size of most of the profit size of most of the cement companies who have been adopting this strategy. I think the pan-India presence of Ultratech and Adani Group companies probably would be the right way to look at, I think, this entire business, and maybe small and mid-sized players would eventually find themselves folded into some of these bigger names. That is what we gather from the market actions house.
Devi, thank you very much for that. Let's get to some earnings reaction. Now, LTIMindtree is one of the top gainers today after Q1 numbers beat estimates. Revenue growth came in at 2.6%. Margins were largely in line. I caught up with Debashish Chatterjee, MD and CEO of LTIMindtree, and began by asking him if the growth rate seen in the current quarter was sustainable. Listen in.
As far as Q1 is concerned, we had a very good start to the FY25 fiscal. And the growth rate that we have, the momentum that we have generated, this is definitely going to get into Q2. The market environment overall has not significantly changed, but so it's a little too early to call out how the full year will play out. But we are very confident that this momentum will certainly get into Q2 as well.
You've also alluded to some green shoots, particularly in BFSI. What is it that we're seeing on the ground?
Well, as you know, BFSI is one industry which is always dealing with a lot of regulatory and some of them translating into transformation kind of engagements. So as far as green shoots are concerned, we are seeing those early signs where clients are willing to, not only looking at cost takeout, but take those, the savings and deploy into some of the high transformation, high priority programs. And also in BFS, we are also seeing some consolidation where we are well positioned in some of those consolidations.
Okay. But this deployment of the savings into high priority transformational kind of project, is it only happening in BFSI, or are you seeing these green shoots even in other verticals?
Well, at this point of time, we have seen it in BFS, and we have also seen it in our other large vertical, which is tech vertical. But we will probably have to wait a little longer and see how it plays out in the other verticals. But definitely the growth that we have seen in this two large verticals, BFS and tech, I think we are definitely, that gives us the confidence that the momentum will continue into Q2.
Retail and healthcare for you were two verticals where we've seen a sequential decline. What went wrong?
Well, we don't, when you say retail, it's all, consumer goods and, retail and travel all together. So there is definitely some impact we had in the travel where it has been slow, and also a part of our real estate portfolio did not do well. Healthcare is a small vertical, healthcare life sciences, so a little bit, once it scales, it's still in the scaling up mode. So I'm not too worried about that. But yeah, we are focusing in terms of retail and travel and hoping it will come back.
In our last conversations, you'd spoken about that you're hoping that FY25 margin should be flattish. Now, you still have a wage hike to give out, which you've called out will happen in Q3. So how confident are you that FY25 margins will be flat compared to the prior year?
Well, when you talk about margin, I always keep saying that margin is cannot be a one-quarter phenomena. It has to be a discipline. So that we have gone through a fairly significant integration, and then coming out of the integration, which is now behind us, we again put back the margin program that we used to have earlier. And when you put together the margin program, you put the program with a view that over a period of time, over the next few quarters, you have a consistent improvement in margin. And that's what we are trying to do. So our confidence is, even with the wage hikes, we should be able to see the margin holding steady and inching a little better than where we are as we go along quarter after quarter.
How long will this margin program play out for you?
Well, it's a discipline. I mean, it's not something that you do for, we probably, could not have done this when the integration was going on. But as soon as the integration was over, we again put back the same program that we used to have earlier, which helped us in the erstwhile Mindtree, erstwhile LTI. And now I think at LTI Mindtree, we have a very robust margin program, which we are very confident about in terms of how the margin can be taken up over.
Your deal wins have been flattish for the last couple of quarters. When do you expect the deal win number to pick up?
So as far as the order book is concerned, it is 1.4 billion for this quarter. And as I have always maintained and mentioned earlier, we don't look at order book on a specific quarter basis, but we look at for the full year. So I would say it's a good start to the year as far as the order book is concerned. And even if you look at the book to bill ratio, that is also steady. One of the things that we are seeing in our deal wins is the deals which are more tenure-based, long-term annuity cost takeout deals. Those continue to replace the project type of opportunities, which only means that the order book should increase as we go along, as well as the book to bill ratio should also improve as we go along.
Last year, your overall headcount declined by, I think, about 2,000, 2,500 employees. This quarter, you've added on you've increased the headcount overall. What's the guidance on hiring and attrition?
Well, as far as attrition is concerned, it has been holding steady. It has, and as far as utilization is concerned, it's all-time high. Given that it's very obvious that as we get into Q2 and as we are saying that the momentum will continue, we have to do hiring quite aggressively. The hiring engine that we have is all ready to onboard more laterals, and we have also added significant number of freshers also this quarter. And with all these things, I may not be able to call out numbers, but I can say the engine is absolutely ready to do more onboarding of laterals as we get into the Q2.
Okay, that's the word coming in from LTI Mindtree. Some green shoots in the BFSI and tech vertical, and they're confident that the growth momentum seen in Q1 will continue into Q2 also. We'll slip into a very short break. On the other side, we'll be joined by Siddharth Vora from PL Asset Management on the other side.
Welcome back. 200 plus points on the Nifty is what we have. 24,831 is where we stand at. Siddharth Vora is now joining us. He's head of quant investment strategy and fund manager at PL Asset Management. Siddharth, good afternoon. Good to have you with us here. Thanks for your time. Prashant this side. Today, momentum stocks are taking a bit of a break. I mean, actually, they're taking a pretty large break if you look at it. Check out the Nifty Alpha Index, which is basically comprised of these names. That index is down 2.5%. Right, your Trend and your CG Power and so many other names, which are down as we speak, and the Nifty is up. So the underperformance is almost 3.5%. I don't think it's happened in a long time. Are we in? And you throw in the defense names as well, HAL and BEL and what have you. Are we in for a slightly sharper pullback in some of these very high momentum names? What's your sense?
So over the last 1 month, actually, we made a very, very drastic change in our portfolios. So we launched our fund in June 2023, and for almost 1 year, we continued to hold a momentum and value tilt in the portfolio. But over the last 1 month, we actually moved out of a momentum value tilt and moved into a quality and low vol tilt in our portfolio. So our fund is actually known to switch its investment style based on the market regime. So it's style adaptive in nature. So I think that rebalance has really, started working in our favor. And I do believe that there is a very, very sharp case for mean reversion as well. So what we are looking at right now is that if you look at the quality factor and you look at its comparison or like a discount from a quality to a value, there is a lifetime high discount between the quality and value factor. So we definitely think that data suggests a strong mean reversion case. Even if I'm looking at my other valuation, breadth, sentiment, and volatility indicators, most of them are at cyclical peaks and troughs, which again suggest a case of mean reversion. So to deal with all of this, what we have done in our portfolio is created a very tactical defense layer in terms of diversifying the portfolio from our standard 25 stock portfolio to a 50 stock portfolio for the first time. The other thing which we've done is created a 30% exposure to defensive sectors such as consumer, healthcare, and a bit of IT as well. So for the last 1 year, we were mainly dominated by cyclicals. We've now finally started adding non-cyclicals as well to the portfolio.
Siddharth, afternoon, Rima here. So how long does this tactical shift, play out? So for instance, how quickly before, this mean reversion takes place? Is this a 2 month, 3 month? Because you've got to be very agile and not all retail shareholders will be. So put your strategy into context with some timelines. So, or in terms of some levels or, go ahead.
Sure. So we follow a 2 monthly rebalance cycle in our portfolio. So every 2 months, we review all the market models, the risk models, the macro models, style models, and sectoral regime models to decide how the portfolio must be tweaked across any of these dimensions. And the last rebalance was the 5th time in the last 18 years where we got a switch into a dual portfolio. So rather than following a single style or a single regime, which was value momentum, we've now divided 50% of the portfolio to value momentum and the other 50 to a quality low vol. And I think this is quite a rare occurrence to happen. As I said, 5 times in the last 18 years. So every 2 months we rebalance. And at the end of 2 months, if this continues, we continue holding the same strategy. If the data suggests that we need to realign again, we will rebalance and tweak some aspects of the portfolio once again.
So that and this you're describing, at the PMS, all strategies are quant strategies, or is what you're describing primarily for one of the quant strategies?
So as a group, we pivoted out of active money management and into a pure play quant asset manager close to 2 years back. So now we're running 3 strategies. All of them are 100% pure quant driven.
Okay, got it. Just wanted that clarity for our viewers. Now, with what you described, and these terms, these days the definitions also change so much. A year back, what was value is now momentum / growth. And these terms are, it's not cast in stone anymore, and it could change in a matter of months. So therefore, now I'm going to talk sectors, right? So let's say if you've got something like, capex, defense, capital goods, this whole basket which has been just zooming ahead, and many of them are PSU stocks as well. What do you call them now? Is that momentum for you, erstwhile value, etc.? And basically, what is the positioning on them?
So I'll give you your take on quality and value. It's very interesting, and actually we've been seeing this and communicating it to our investors as well. So the erstwhile value factor is no more value. The actual value is in the quality factor. As I said, the discount between quality and value as a factor is at cyclical highs, which means quality has never been cheaper as a basket and value has never been more expensive as a basket. So there is actual value in the quality factor. Having said that, we've reduced our exposure to industrials, cap goods, defense, that whole pack from a 38% exposure, say 1 month back, to a 26%. So we've cut that exposure by 12%, and that's moved to healthcare now. So we've created a layer of defense in the portfolio. As I'm saying, we do perceive some sort of mean reversion in the markets as well. So 12 months, we perceived the markets to be in a risk-on mode. Now we are perceiving the markets to be in a risk transition mode.
Hi, Sid. Good afternoon. Good to see you in. So you're moving some money out of industrials to healthcare. You want to categorize healthcare because that's a very, very large segment out there. How are you all playing it?
No diagnostics and hospitals. It's just the pharma names.
Oh, just the pharma names. All right. Yes. Well, what about, if you could give us a sense on the banking names, how are you all positioned out there? Because there's been that raging debate over there on banks that, yes, there is valuation comfort, but there's a split verdict, whether the PSUs have more fuel in the system. How are you all positioned over there?
So right now, we don't own any private banks in the portfolio. And as of now, not even PSU banks. In the last 12 months, we've had a healthy around 22% odd financial exposure. But in the last 12 months, we've not even owned a single private bank. So we've created significant alpha from our financial exposure, but we've mainly owned PSU banks, PSU NBFCs, and all the capital market plays. So just to give you a few names that we've owned in the past, no more own them. It's been BSE, PFC, REC, Nippon India Asset Management, HDFC AMC, Motilal Oswal. These have been some of the names that we've owned in our portfolio. We've already exited them, I would say, 2-3 months back. So we no more own them. But this is how we've played our financial exposure through a set of diversified financials, I would like to call them, rather than the traditional private banks.
Siddharth, in terms of your published portfolio, can you just give us a flavor of the sort of top five or six holdings right now?
So the good thing or the more differentiated aspect of our portfolio is that we run an equal weighted portfolio. So there is nothing like top five. I could just tell you my top 5 performers rather than my top 5 holdings, right? And in terms of our sectoral mix, we have autos at around 28% of the portfolio, which covers the ancillary pack and the automobile OEMs. We have industrials at close to 26% is industrials, healthcare at 12%, consumer at another 16%, and IT at 4%. That's the broad breakup of the top 5 sectors that we're owning right now. I forgot real estate. Real estate is at 7.5% as well.
And which are each? What's the name each from each of these sectors, Siddharth?
So I'll tell you some of the big winners in the industrial SPAC have been Cochin Shipyard, Mazgaon Dock, GRSE, GE Shipping, HAL. These have been some big names. From the auto pack, we've had Bajaj Auto, Hero Moto, M&M, Maruti. These have been some of the big names that we've been owning. In real estate, we have Oberoi, Loda, NBCC, and in MRF also in the auto pack.
Sure. In that defense, industrials, lastly defense name, not defense, I mean shipbuilders, etc. What are you doing with those now, Siddharth?
So as I said, we were owning 4% to each of them 1 month back. We've now pruned the allocations, booked significant profits, and the allocations are now down to roughly 2% each. So we booked significant profits in all these stocks, which we've been holding for good 6-8 months in our portfolio.
So Siddharth, just to conclude, and again, I'm going back to slightly more academic question. For a lot of quant strategies, momentum is a very important factor. And as long as you have a trending market up or down, I mean, quant strategies work pretty okay, right? Correct me if I'm wrong. But as a house, what's the call that you're now taking? Are you expecting this to get into a bit of a ranging market? Because you mentioned, and that's therefore the changing positions that you're taking.
Right.
And, you know, as a overall strategy, is it value, quality, momentum? What's the overarching theme that defines the three of the strategies that you discussed today?
Sure. So, firstly, momentum is usually an important factor for quant strategies. But in the fund that we're talking about today, or the strategy we're talking about today, which is Aqua, it's actually a style agnostic and style adaptive strategy, which means momentum is just one of the factors we look at, with not more than 20% weightage in stock selection. But based on the cycle we're in, the weights of the different factors changes. For example, right now, quality and low vol are the most dominating factors in our portfolio, followed by value and then momentum. So till December, momentum was the dominating factor. Post-December, value and momentum became dominating factors. And now quality, low vol are becoming dominating factors. So we are not focused only on momentum to drive returns. Sometimes we focus on alpha generation on the upside. Sometimes we focus on risk-adjusted returns like we're doing now. In terms of style orientation, as I said, first time in the last 1 year and fifth time in the last 18 years, there is a regime split, which means what our models are trying to tell us is they neither have conviction that value momentum regime will continue like it did for the last roughly 2.5 years, neither do they believe fully that quality is now the dominating regime, which is why they've given us a model portfolio which splits equally across both of them. So 25 stocks from the quality low vol pack, 25 stocks from the value momentum pack, all given an equal 2% weight. So it's a 50.
Got it. So your models are telling you that we are at crossroads in this market. Interesting. We are going to remember that and look forward to discussing this in the future as well. Thank you for joining in today. Well, that's a view from Prabhudas Leeladhar from the PMS strategies that they are adopting. We will take a break on that note, come back on the other side, and of course, then we'll get you some key excerpts from our very, very interesting conversation with Chris Wood. Welcome back. Let's get you that exclusive with Christopher Wood of Jefferies. India is the best long-term equity market in the world. That is what Chris told us as he visited the CNBC-TV18 studios for a town hall on the markets with some of the biggest market stalwarts in attendance as well. And the names included Ramesh Zamani, Utpal Sheth, Ravi Dharmshi, among others. In a one-hour-long session, Chris Wood gave his take on the performance, valuations, and the outlook for the Indian market going ahead. Take a look.
India is the only stock market I'm aware of right now where the small mid-cap sector is doing way better than big caps. Absolutely unique. And it's driven by this domestic phenomenon. This is not replicated in any other market right now. India is the best long-term equity market in the world. Clearly, the US has done fantastically well. But in the emerging market Asian context, India to me remains the great domestic demand story. You have this very emerging equity culture. But what, as you rightly have just highlighted, is amazing is the dynamism of the local asset management industry and the growing retail participation. And actually everybody, I've been in Mumbai 2 days, everybody from the financial industry, I think, is staggered by the resilience of the market following the surprise election result. My understanding, obviously, the excess valuations in India, or the perceived excess valuations of the small mid-cap area, but my understanding in recent quarters, they've had the best earnings growth too. So it's not completely divorced from underlying fundamentals. No, the only issue, the risk in India is simply that some of these stocks are very high valuations, so there's a risk of earnings growth disappointments. The big point for your viewers to understand is the foreigners are remarkably underinvested in India. So we believe that the global emerging market funds, who are the prime investors in Indian equities, are barely neutral in India, partly because the neutral weighting of India has gone up because it's outperformed, and partly because they haven't really been able to get into the market because the local money has kept it at valuations where they're not comfortable with. I've been telling investors, well, they got obviously crazily cheap when oil went negative, so there was an opportunity there. But also, frankly, if you want to hedge geopolitical risk in a global equity portfolio, your only practical way to hedge that is energy. And actually, even in an Indian portfolio, if you want to hedge the risk that oil suddenly goes up, because obviously this Middle East situation could... I've been primarily focused on Russia and Ukraine as a risk, but the Middle East is a potential risk. The only practical way to hedge that is energy, and these energy stocks pay good return. Dividends, they're defensive, but they could be like tobacco stocks. Tobacco stocks the last 20 years have been good performers. Sector I first heard about 3 years ago, but in terms of my portfolio, I've missed the defense stocks. But the problem in India is what not to own. Right. So my portfolio has been basically built on the... where the performance of my greed and fear portfolios come from the last year, I would say in property, energy and infrastructure, but the missing part of my portfolio is defense. So let's say there's a sudden resolution of this conflict. Maybe the defense stocks will correct, and that will be an opportunity to add.
Please rectify that for us.
Yeah. And then another emerging area in which I'm not invested in, but I mean it's definitely getting more and more attention, is the contract manufacturing sector.
Right.
I believe you call it EMS.
Yes.
So this is an example of another emerging sector. Well, from a US perspective, Donald Trump will be risk-on for equities because his first act will be to extend the tax cuts. But for the interesting question is what Donald Trump would mean for the dollar and the US bond market. On that environment, I think my guess is Donald Trump would lead to a weaker dollar, much more likely to see this Ukraine-Russian conflict resolved, which will then would lead the market, I think, to cause, that should logically cause oil to sell off. And there will also be expectations that Donald Trump will go out of his way to what he calls drill, baby, drill, i.e., increase energy production.
Okay, well, that's Chris Wood on a wide variety of subjects, and you can sort of watch that interview later during the day. We'll continue to play snippets, and of course, you can go online to CNBC-TV18.com and find the entire interview as well. We'll take a quick commercial break here. 200 points higher. We're at about 24,800. It's a sharp, sharp reversal. It's large caps, though. I mean, as we've been pointing out, mid caps, small caps are sulking today. We take that break. We're back. We'll get you some technical trading ideas. Amrish Baliga will also be joining us when we return. Stay with us.
Welcome back. It's still a very good-looking screen with the Nifty managing to stay above 24,800. Mitesh is with us, so let's get some more trades in. Mitesh, it's really green all the way. Every dip getting bought. What would your final advice be for today?
It's been quite positive, but I have one BTSC and one STBT. On the selling side, the Siemens, I think, closing with a lot of negative setup on the hourly daily charts. So STBT here is the stop at 71.60. Look for target of 70.30. And State Bank will be a BTST with a stop at 886.5 for targets of 905.
Okay. All right. Got it, Mitesh. Thanks very much. You enjoy the rest of your day, and we'll connect again tomorrow. For the time being, let's get back to some fundamental opinion on the market. We caught up with Ravi Dharamshi, CIO at Value Quest Investment Advisors, after our market town hall. Got his views on the way forward for the market, as well as, of course, expectations from the budget.
I think we are in the midst of a bull market, and it's driven by fundamentals, it's driven by earnings, it's driven by a deleveraged corporate sector, and corporate earnings are keeping track of the market. So, yeah, of course, we'll probably move a little ahead of earnings from every now and then, which might be a cause for correction. But I don't think there is anything that is going to change the structural nature of the market.
Any cause for worry, given that we've not had a meaningful correction in almost 3 years now? I mean, post-COVID, it's been a one-way rally with very short and shallow corrections.
Yeah, absolutely. It's been 4 years, not even 3 years. It was March 2020 and we are here in July 24. So clearly, correction at some point of time will be there, and it will be a deeper one. And I don't know what will cause it. Is it going to be something in budget? Is it going to be US election? Or is it going to be just the supply of paper that absorbs all the money that is coming into the market? Any or all of these can cause the correction, and I wouldn't rule out. Just the law of averages suggests that at some point of time in next 6-12 months, we should have a deeper correction. But the bigger point is it will be a correction and not a reason for you to be out of equity as an asset class. I think the longer term wealth creation journey will still continue. Use that correction whenever it comes as an opportunity to start building longer term portfolio.
Absolutely. Allocating money at all-time highs is always a far more difficult task than to put it to work when the market is down. So for anyone who's looking to enter now, because you don't want to miss out waiting for that elusive correction, what would your advice be? And what are your go-to sectors where you think there's still some reasonable, risk-reward, equation which you can work with?
So, clearly, the first thing, if you are not allocated or under-allocated to equities, is to get allocated. I don't think that is going to change. However, this is not the time to be building, going whole hog and building a portfolio for a 5-year, 10-year period. There will probably be a better entry point. In terms of sectors, I think this recovery post-COVID has not been exactly even. So there are sectors like rural consumption-oriented, agri. There are chemicals, which has not done well for the last 3 years. There is IT services, some platform companies. All those kind of things are probably due for a reversion to mean kind of a trade. But my lookout will probably be where the structural change is happening.
Well, the run-up to the big event, the union budget, there's a lot of chatter around possible tax changes and what the preferences will be for the government. What's your take?
No, I don't think equity as an asset class is going to be disfavored or unfavored by the government. I think we'll continue to, keep the tax rates that they are. It would be foolish on my part. It would be foolish on the part of the government to actually tinker around at this stage of the cycle where the private capex is about to begin. I would, of course, there is a problem to be solved in terms of the banking deposits, which are actually running dry. So maybe some amount of incentivization on that part, but not taking away from the equities would be a fine balance that I would be looking for. Second thing that I am looking for is how they manage the the pulls and push of the coalition government. Is there a need to, are they doing a hard turn towards consumption-oriented and welfare-oriented sectors, or is it just going to be a lip service paid and continue on the supply side reforms on the capex side? That is two monitorables for me for the budget, but I would expect it would to be more of the same with just a little bit on the incremental side.
All right, that's the view from Ravi Dhamshi on the market as well as budget expectations. So we will quickly take a break on that note, and we'll come back on the other side. I think we'll have also Ambrish Baliga joining in. So back with that in just a bit. Well, who would have thought we'd have that countdown timer or ticker up so quickly? But yeah, that is a distance to the next milestone, 25,000, pretty much in sight. Amrish Balika is with us on the show this afternoon. Amrish, thank you for joining in. Amrish, it's been a spectacular rise, right? And even as we were waiting for banks to start firing up, IT started doing it. And the market's hoping Infosys is going to continue the good cheer. What have you made of frontline IT, the commentary, and are you looking to buy anything at this point in the space?
No, in fact, this is what I've been saying now, I think, for the last 2 or 3 quarters, that possibly Q1 FY25 should give that trigger for the IT companies. And I mean, that's what I think we are seeing right now, because this is one of the few sectors where the valuations are still worthwhile. It had underperformed in the past couple of quarters. So it's still an opportunity to get into the IT space as well as FMCG. I mean, I would say both these spaces look good at this point of time, where in a market it's very difficult to find value. But these are the 2 pockets where there's some value.
Okay, let's talk about your stock, Amrish. AI engineering. Tell us about it.
Yeah, I mean, it's a global leader in grinding solutions with about 35% market share across 125 countries and over 95% dominance in India. 4 manufacturing facilities, Ahmedabad, Nagpur, Bangalore, and Trichy. And the consumer industry for them is cement, mining, and thermal power generating companies. The export business covers important geographies like North America, Latin America, and Australia. Their current capacity is about 460,000 tons, and now with an additional capex, it should go to about 496,000 tons by the end of this year. I mean, FY24 was a bit challenging, but the estimated revenue growth over the next 3 years, I'm seeing a 15% CAGR. I think the only risk which is there on the horizon is the anti-dumping petition in US. But I mean, they have seen that, done that in the past as far as Canada and Brazil is concerned. So my expected EPS for FY26 is about 165, and with that, my target is about 4,950.
Okay, that is AI engineering and sort of Amrish's explanation with how things are there. Amrish, you know, the other space, right, you began by saying that's tough to find value. The entire sort of defense space, 2 days running now, and today it's even more stark because HAL is also down. You know, some of the other names, CG Power is down 5.5, Trent is lower. This is all very high momentum, which is done exceedingly well. Well, we're starting to see some cracks, very, very initial. But do you think, you know, this space could be in for a slightly sharper pullback here?
It has to, because see, I mean, about 4 years back, we were finding it difficult to justify about 8 or 10 PE for these stocks. And today the market is justifying 10x revenue. Forget PE. We are talking of 10x revenue for most of these stocks. So you see the sort of expansion which has happened out there. I mean, no doubt things have started looking much, much better than what they were in the past. I mean, order flows have been excellent. But then the market has discounted the order flows. I mean, clearly the whole space has expanded, no doubt. But what about execution? I mean, we have seen large companies like L&T, BHEL faltering on execution. And no one is really talking about the defense companies' possibility of faltering on execution going ahead. And what would happen if there's a falter out there? And at the same time, I mean, will they keep getting fresh orders to be delivered after 10 years or 15 years? I mean, that's another question which has to be asked, because most of them are full with the order book for the next at least 7 to 8 years. So I think it's high time they corrected. I think reality has to strike somewhere. I mean, you can't be in a dream world all through. So I think the correction has to be much deeper than what we have already seen.
Okay. By the way, just very quickly, 2 big stocks came out with numbers today, Polycab and Havells. Amrish, in Havells' case, the numbers were good year on year, but not as good as what the market had in mind. And Polycab was also a bit of a miss. Your thoughts on these two?
I think Polycab, we've already seen a decent run-up. So with a bit of a miss, I think we should see a further correction. But then again, it will not be a deep one. I think we could see levels closer to about 6,100 or 6,000 levels. And Havells, overall, it was decent, although the market may see a miss. But I mean, I would still stay on with Havells.
Okay, stay on with Havells still. Amrish, we'll leave it there. Thank you for joining us here. But of course, we'll continue the conversation after we wrap up things. I mean, 180 points higher is what you have on the Nifty. We are at 24,790 on the index. So that's essentially the closing rates which are starting to come through. Nifty Bank is up about 190. That's about 1/3% higher. And IT started with a 0.5%. I mean, you know, the Nifty started down and it was down deep in the red. The IT index was up 0.5%. This was at in the morning 9:20. It ends with 2.25% gain, the Nifty IT index. So that is clearly the number one singular reason why, I mean, the large cap indices sort of swung back in such a dramatic fashion. Broader markets, I don't think there was any real big recovery. Mid cap and small cap indices on your screen, about a 1% cut there. 1,800 stocks are lower and about 900 stocks higher. So, I mean, clean 2:1 declines outnumbering advances today.
Absolutely. Just to name some stocks in the mid cap arena, just dial 20% circuit is what we're talking about over here. It was the big winner. Otherwise, I mean, the mid-cap index ending with a cut of almost 1%. Z, by the way, after that FCCB issues, down about 8% as we are closing out. We discussed Polycab down about 1% after earnings. Havells down about 0.25%. If we talk about some of the other key losers, it's some of the high flyer PSU stocks, the railway names, RVNL, RailTel. This is where the money was coming off. Even the others, NHPC, NALCO, BEL, NBCC, BHEL, basically the PSU basket was where there was a bit of a cool-off. Non-PSU, look at Trent. So, you know, just an example of the fact that today was a day for some profit-taking on stocks that have moved up very sharply in the last few months. But otherwise, 166 up on the Nifty and the index just below the 24,800 mark. Well, with that, it's curtains on this edition of Closing Bell. Thank you very much for watching, but stay tuned. We will continue all the market action. Up next is Markets Forward.